yields are under pressure, and we've really talked about how muni yields have been following treasury yields higher as well. And I mentioned the acronym earlier, TERRA. There is a reasonable alternatives. Within fixed income, is this finally the place to get it back from the depths of there being no alternative within the world of equities? Really pleased to say that Paul Malloy, head of municipals for Vanguard, joining me now here in studio. And to kick it off, we have to talk about just that huge rate volatility. Are municipals a way for safety, for stability, or are they too following the treasury rate amidst all of this vol?
So munis are following the treasury volatility, but it's been mostly concentrated on the front end. Municipal front end yields were particularly rich after the summer, and we've seen a backup to more normalized levels. The long end of the curve has been much more stable and has been tracking treasuries a little more closely.
We talk about the acronyms. For a long time, yields were so low that there was no alternative but to just go all FOMO, all in the equity market. With yields rising, is it actually the first time you can get some decent yield within fixed income in your world of munis?
Yeah, and munis are the best spot to get it right now. With ratios over 100% in the long end, you're getting tax-exempt yield at a taxable price. So taxable equivalent yields are north of 5%. And you've got the fundamental safety of munis. They're in the best fundamental shape they've been in decades. So it's really a great spot to invest in the fixed income market.
Is it still safety, though, when you think about state and local governments preparing for what could be maybe a slowing growth or a recessionary environment? Are state budgets and the health of high yield, even investment grade municipals, where they need to be at this point in the cycle?
Yeah. Investment grade is very, very safe at this point. Coffers are full, tax receipts, rainy day funds. Once you start to get to the deeper recesses of the high yield market, that's where you have to start being picky project by project. There are a lot of deals done in 2018, 2019 that are having some ramp up challenges, potentially some higher cost of refinancing. So we're a little more careful in the high yield space.
Remains a big fan of the American Dream Mall out in Jersey, but we will not get started on those specifics as of now, but sort of an indication of what could be if you don't really maybe do some of your homework and understand the balance sheet. Talk to us more about some of the inflationary pressures underway, or some of the state and local governments, and even the employee public wages. When you think about those inflationary pressures, is that sort of a boost for your credits?
So it's a boost for the revenues. Higher wages, higher tax receipts.
Right.
And on the property side, property taxes are actually relatively stable. So we're not really going to see any impact from inflation as it pulls through from the housing prices. You buy your house, get it assessed, a relatively stable tax draw, which is what most local governments and school districts fund themselves off of, versus the state level is more tax wage revenue.
I want to talk about the issuance market. We talked a lot about with the big rate volatility. A lot of deals that came a year or two ago, they are tapped out of the market. Refinancing is over. If you didn't come, you can't come now. Are you seeing a slowdown in the issuance market amidst all this volatility?
We expect issuance to be slow all year anyways. State and local governments were flush with cash, and they really didn't need to issue. They were only going to issue if rates were really low. Rates moved up, and they got cash. So we always thought that they were going to be very light in their issuance this year.
Finally here, what's sort of the biggest question on clients' mind? When they call you, what are they worried about?
They're looking to see, what is the right time to get in? How do I work through this volatility? And municipals are such a great asset class to hold through volatility because you get to pick up tax-exempt income. They're in great fundamental shape, and default rates are so low relative to many other fixed income asset classes. So it's really a great spot to ride out an inflation storm.